out there feel like they have a really strong sense for what an investment bank actually does? Like maybe with the show of hands, like I really understand what investment banking is. Okay, just a few hands. Okay, that's a helpful starting point. So investment banks do a lot of things, and frankly, it's not as complicated as it seems. And so I wanted to kind of simplify some of that down for everybody today. And I think a good analogy for this is a real estate broker, actually, who you might hire to sell your house. Investment bankers, one of the main things they do actually is sell companies. And so while investment bankers might be brokering the sale of a company, an easy, kind of less abstract way to think about this is for anyone who's ever bought or sold your house, you might have hired a real estate broker to handle that sale. And if you did that, one of the first questions you'd probably ask of that broker is, well, what the hell is my house actually worth, right? That's what you'd be curious about. So if you owned a company and you were going to take it to market for sale, and you hired a banker to do that, the first question you might ask them is, well, what is my company actually worth? And so your real estate agent, they might do something like look at, well, what did your neighbor's house sell for? Or what did, the last 10 houses in your neighborhood, what did they sell for? Take the average on a price per square foot basis, and then they would apply that to the number of square feet in your home, and they would come up with a valuation. Your house is worth this. So to make banking less abstract, that's a big part of what iBankers do. And so I have built a model that's kind of rooted in traditional quantitative analysis around this. And the idea is to help everybody understand how would you value a company, how would you value a blockchain, how would you value a token. And instead of walking through the model, because that would be pretty abstract, instead I took that model and I valued the Ethereum blockchain. So what we're going to do is we're going to walk through a valuation of Ethereum today, and hopefully you can use it in some other pockets of your life. If there's one thing that you take away from what I have to share today, I would ask that it is just this, that when you're valuing something, if you're valuing your project, if you're valuing a company, that the valuation is rooted in quantitative analysis. I meet with a lot of founders who are raising money for their projects, and it's kind of finger to the wind sort of valuation, or what they're trying to accomplish is to maximize the amount of dollars that they can raise and minimize the amount of tokens or the amount of equity that they have to give up to do that. That is not the right way to do that. That may seem like the right way in the very short term, but in the long term, what you really want to create is a win-win partnership between a founder and an investor so that it's successful for both parties for the long term, because the real benefits of that type of partnership will come in the end. Okay, before we dive into the model, who am I? My name is Brian Russ. I've got 20 years of experience in investment banking, corporate banking, hedge fund management, and I run a family office. Today, I run the state of Colorado for BMO Financial Group. We are 1.3 trillion in assets. We're the 8th largest bank in North America. Here in Colorado, I manage 2 billion of capital, and we have 800 employees. Mostly, we are involved with helping large companies and their capital needs. The other hat I wear is as CIO of my family office, 1971 Capital. We are investors in disruptive technology and have been investors in the blockchain space since 2013. Okay, let's jump into the model. The model is actually 4 different models. So we're going to use 4 different approaches to valuation here, and then at the end, we're going to take a weighted average. So I won't talk about the models here. I'll talk about them as we get into each of the 4. One quick note before we dive in. The valuation process, whether it's for a company or a blockchain, the reality of this is that it is as much art as it is science. And it matters immensely what types of assumptions we make. The assumptions will drive the valuation. So we want to first be accurate with our assumptions. Second, we want to be conservative with our assumptions. And then third, we want to make sure that we state what our assumptions are along the way, because ultimately they drive the valuation. So please keep that in mind. Okay, let's start with model number 1. There are 4. So model number 1 is discounted cash flow. If you've ever taken a finance class, this is like Finance 101. This model essentially says that your company or your blockchain is worth the summation of all the profits that it will generate forever, in perpetuity. So your blockchain is worth the amount of profits it will generate for you this year, plus the amount of profits it will generate for you next year, and the year after, and the year after that, forever. And so what we do is we have to build a model to project forward what those profits are, and then we use a discount rate to bring those profits back to 2023 or 2024 chain dollars so that we can say what is the project or what is the company worth today. So let's take a look at this model. So first we've got to come up with a proxy for what are cash flows and how quickly are they growing. So first I attempt to answer how quickly might cash flows or profits grow on the Ethereum blockchain. And so for that, we're going to look at wallet growth. If you go on EtherScan, you can see that wallets on the Ethereum blockchain have been growing at about 36% annually for the last 5 years. So we use a slightly more conservative metric of 33%. So we assume that Ethereum wallets, total wallets using Ethereum, grow at about 33% per year for 10 years. If we take that math forward, that means that we'll have 4.5 billion users by 2033. So that's about half the world's population. That's a good back check to make sure that our assumption around growth is reasonable. And while I would say half the world's population is a lofty assumption, I think everybody sitting here is here because they think that type of growth and adoption is possible for this industry. Okay, let's take that growth rate, that 33%, and let's apply it to Ethereum's cash flows. First, we have to say, well, what are Ethereum's cash flows? What type of profit does the Ethereum blockchain generate? In order to do that, I actually ended up using the same profit methodology that's used on ultrasound money. So if anyone's been there, great website, great resource, go check it out. And in order to do this, we essentially look at a proxy for Ethereum revenues, which we use as burn as the proxy. So burn are the revenues, essentially, on the Ethereum blockchain. And then issuance, we would call the expense. So the issuance is kind of the inflation. It's what you have to pay the stakers. And so if we take the revenue, the burn, minus the issuance, the expense, revenue minus expenses equals profit. Okay? And so if we do that, we get a profit figure of $1.8 billion that the Ethereum blockchain generated in 2023. And so we're going to take that 1.8 billion, we're going to grow it 33% per year for 10 years, and that's what's represented by the black bars. After year 10, we're going to use a slightly more modest growth rate of 5%, and then we're going to take all the value of all those cash flows and we're going to discount them back to today. And to discount back, we use something called the risk-free rate or the Fed funds rate, which is 5%. So we'll bring all those cash flows back to $2023 or $2024. And here's what the model tells us. If we do this exercise, the Ethereum blockchain, represented by that pink bar, is valued at $458 billion. The actual valuation is about $400 billion today. So this model suggests there's a 15% premium, that, in other words, that Ethereum is undervalued at today's prices by about 15%. That's interesting. Let's jump to the next model. Okay, second model is precedent transactions. I've got a picture up here of a residential neighborhood. Let's go back to our you're selling your house example, and you asked your broker, what's my house worth? Well, they're going to look at what your neighbor's house sold for. We already talked about that, right? So that's essentially what we do here. We want to look at other technology companies, what they've sold for, and use that as a proxy to value Ethereum. So because Ethereum's early stage, we can't really look to other blockchains. So instead, we're going to look to other early stage tech companies that became the dominant player in a network that they created. I thought this was a good comp set. So here you can see we're looking at Amazon, dominant in e-commerce, Google, dominant for search, Meta, dominant for social networks, et cetera. We add Netflix, Tesla, Uber, and we're going to look at something called the PE ratio. Many people might be familiar with that. Price to earnings ratio. It's just the ratio of the price of a company's stock divided by the earnings that it generates in a 12-month period. And so in order to do this for those companies, we've got to rewind the clock and go back to when they were earlier stage so that it's more apples to apples with Ethereum. But we don't want to go all the way back to the point where before they were profitable, right? Because then we wouldn't have the E. We wouldn't have the earnings for that ratio, and we wouldn't be able to calculate it. So what I did was I went to the first profitable year for each one of those companies, and I looked at their PE ratio for the next 5 years, took the average, and that's what's charted in the black bars, the average PE ratio for the first 5 years of profitability for those projects, or those companies, excuse me. And then if we take the average, that's that pink line, 178. And so what we want to do is take that average PE ratio of 178 and apply it to the Ethereum profits of, again, we talked about 1.8 billion. So 1.8 billion times 178 PE ratio gives us the value of the pink bar there, which is to suggest that the Ethereum blockchain is worth $321 billion. So this model actually suggests that Ethereum is overvalued today by about 20%. Interesting. Let's look at the next model. Okay, the next model is something called market comparables. Investment bankers call this comps or comp sets. Here we're going to, instead of looking at Google and Amazon and Netflix, we're going to actually look at other L1s that directly compete with Ethereum, and we're going to see how are they valued, and then compare that to Ethereum's valuation. So let's dive in. In order to do this, I wanted to come up with a standardization metric that lets us look kind of apples to apples across different L1s. So here I've pulled the top, including Ethereum, top 6, but excluding Ethereum, top 5 L1s by market cap. And the black bars are showing market cap divided by total value locked. This is a ratio MC to TVL that's becoming more and more widely used in our industry. Now, what's interesting here is that these get kind of all across the board. You know, something like Tron is at 1.4, whereas Cardano's at 55. So instead of taking the average, what I did was I took the total. So we took the sum of the market caps for the top, in this case, 6 projects, we'll include Ethereum, and we divided it by the total value locked on those 6 projects and came up with a total MC to TVL of 8. That's that little pink bar on the left-hand side. Now we have to take that and apply it to the Ethereum blockchain. To do that, we'll take 8 and multiply it by Ethereum's TVL, which is about 47 billion. And when we do that, we get the big pink bar on the right-hand side, which suggests that the Ethereum blockchain is valued at about $376 billion based on MC to TVL. So that's actually pretty close. That would suggest that the blockchain's about 6% overvalued, a rounding error. Okay, let's jump into the fourth and final model, Metcalfe's law. Many of you may be familiar with Metcalfe's law. John Metcalfe was an early internet pioneer, and he essentially came up with a theory that network valuation is actually, because of how it scales, the growth and the valuation is exponential. It should not be valued on a linear basis. It needs to be valued on an exponential basis. And so the simple example for this is the telephone. So if you think about a telephone network, if you add one more user to a telephone network, you don't get a value accretion of 1. You get a value accretion of greater than 1, because that now new phone can connect with every other phone on that network. So it's not scaling linearly in terms of valuation, it's scaling exponentially. And Metcalfe came up with a formula for this. That formula is V, which is value, equals N squared. So it's pretty simple. N equals the number of nodes on a network, and then you just simply square them to determine the valuation. So it's a very simple model. Here, I went on Etherscan again and made an assumption around monthly active Ethereum users. Here, that's about 15 million. And then we just simply take the square of that. If we square 15 million, we get that pink bar, $225 billion valuation for the Ethereum blockchain. So this one actually suggests that Ethereum is quite overvalued by about 44%. It's the most kind of out of line with the other models. Interesting. Okay, let's jump into the valuation. Let's put it all together. So here we've got our 4 different models with 4 different valuation metrics. And what we did is we applied a simple weighted average. So we take 25% of each of the 4 models, we sum that, and we come up with a model weighted average valuation for the Ethereum blockchain at $345 billion. This is about 14% below Ethereum's market cap today. You know, what's interesting is that my data probably lags about a week, and I think ETH is up about 15% over the last week. So let's just say the ultimate conclusion is that the Ethereum blockchain, based on this model, is fairly valued, plus or minus 14, 15%. Okay, so that's not the most exciting conclusion, but it's important, and this exercise is important, and that's where I want to kind of conclude. So first of all, key takeaways. We touched on a few, but I want to reiterate them. When you're making a valuation model, the model itself and your assumptions, they should be accurate first. They should be conservative second. This is important. Also, we want to make sure that the model is always rooted in this type of quantitative analysis. Again, that's going to create those win-win type of outcomes for founders and investors where your partnerships can be successful over the long haul. And then if you guys are just investors out there and you're thinking, how does this apply to me? If you built this type of model, it might actually help you identify some arbitrage opportunities. So let's say we had done the model and we all felt reasonably comfortable that the Ethereum blockchain was worth 800 billion instead of 400, well then we could invest with the expectation that we might double our money in short order. So it can be helpful for arbitrage as well. Okay, this I think is probably the most important conclusion if you're an investor. Again, it might seem like, well, we went through this whole exercise and at the end we just determined that the market value was what the model said. Isn't that kind of disappointing? In my mind, it's not, because what that tells us is that through this rigorous quantitative approach, we're able to determine that the valuation of the Ethereum blockchain is actually fair. We think it's fairly valued. And the reason that's important, especially as investors, is because it gives us the conviction that we're investing in something at fair value, and with that conviction, we can hold on to it for the long haul, for 3 years, 5 years, 10 years. Imagine if you had done this exercise and determined that Ethereum had this upside potential back in 2016 or 2017, and you were going to hold it for 10 years, you'd be sitting in very good shape right now. So I think that is why this exercise is important. You can develop a conviction rooted in quantitative analysis around why you're investing in an asset and how long you want to hold on to it. And then lastly, I mentioned a 17x return. What's that? Well, let's look at some simple compounding. So we talked about Ethereum wallets and therefore profits growing at 33% per year based on the historical trend. If that trend continues for 10 years, $1,000 invested today would be worth over $17,000 by 2033. So this is why the model is helpful in these types of projections. It's helpful for the conviction that's necessary to hold on to something for 10 years. And I think that's kind of the ultimate conclusion and what I wanted you guys to take away from today. So I am down to the end of my time, but I really appreciate everyone coming here today. If you want to get in touch with me, I'd love to get in touch. QR code takes you to my website. If you're a founder and you're raising capital, feel free to reach out. If you're a founder and you want some help valuing your blockchain, please feel free to reach out to me there as well. Or if you're an investor and you just want to network and connect and share ideas, I'd love to do that as well. My email address is up there and my Twitter DMs are open. So thank you all so much and hope you enjoy the rest of the conference.
Thank you, Brian.